This is the Alhambra Investments Weekly Market Pulse with Joe Calhoun. And Joe, you called your report this week counterintuitive. And let me start with a list of things which will come into play here. Tons of reports last week, negative: housing index, housing starts and permits, mortgage applications and existing home sales, manufacturing index, jobless claims, leading economic indicators, and the market went up. As they used to say on TV, explain that to me, Lucy.
Well, okay, this is one of the things I learned early in my career. Usually it was applied to an individual stock, but if you get bad news and it doesn't go down, that tells you something. And what it tells you basically is that whoever wanted to sell this thing is already sold. And I think that's kind of where we are now. Look, that can change. The news could get worse. It could get them a lot worse. Who knows? I don't know where that's going. I'm just going to tell you right now that where the data is right now, it seems as if whoever wanted to sell based on this expectation has already done so. The same thing happens in reverse, by the way. If you get good news and it doesn't go up, that tells you something too. That tells you that whoever wanted to buy it's probably done buying. So look, this is about sentiment. It's not just about the data. It's about the sentiment around the data, how people feel about it. And I think that that's the point I was trying to make this week is that, you have to pay attention to sentiment.
Well, now you put a quote in there that I've heard you say many, many times, and you reminded people that the market's not the economy and the economy is not the market.
Yeah, look, today's economic data is essentially inversely correlated with the stock market. When things are at their worst, the market, the outlook for the stock market is better. When things look great, that's when the outlook for the stock market is not going to be great. It's just a matter of how people react to this stuff. So, I think that people get confused sometimes. They look at the economic data, and that's what Howard Marks calls, and I quoted this in the piece from Howard Marks, he calls that first level thinking. The economy's bad, therefore sell stocks. Well, that's not the way this works. And I think that if you're doing that, you're kind of doing it backwards. You need to be looking at the market to figure out what the economy is going to do, not looking at the economy to figure out what the market's going to do.
Well, you put in there too, economic data is looking back, markets are looking forward. And so in somebody's sentiment, they've got to incorporate that.
Well, that's true. I would say, though, that even the economic data, even though it's backward looking, it does have an impact on sentiment. I think it's going to be interesting this week. We're going to get a GDP report on Thursday for second quarter. I think it's kind of widely expected that second quarter GDP number is going to be negative, which would be the second one in a row. And everybody wants to say, well, that's a recession. And now there's this thing out from the White House saying, look, 2 consecutive quarters of negative GDP is not a recession. And people on Twitter and online are saying, oh my gosh, they're changing the definition. Well, no, they're not. The NBER, which is the dating committee at the National Bureau of Economic Research, does not define recession that way. So the definition hasn't changed. But that first quarter GDP was negative primarily because of trade, which means what it meant is that China was shut down for the whole first quarter. Well, duh. So you ended up with a giant trade deficit because we continued to import, but they weren't accepting our exports. So we had a huge trade deficit. Well, the trade deficit got a lot smaller in the second quarter. Anyway, the point is that everybody's looking at that second quarter GDP. I even see people online saying we've already gotten a recession because Atlanta GDP now says that second quarter GDP is going to be negative. Well, that's a complete misunderstanding of how the Atlanta GDP now spreadsheet works, but it doesn't matter. Look, I think it's going to be interesting to see how people react to this. What if that number comes out positive? What if that second quarter GDP number is positive? We know, for instance, that the trade figures, the trade deficit, improved considerably in the second quarter. And if you just assume that the June numbers are going to be similar to May, because we don't have June numbers yet, then you're probably looking at a plus 1.5% on GDP just from trade. The other wild card is inventories, and I'm not sure exactly how that's going to come out. But the point is that you may well get a positive number in that GDP report on Thursday, and it's going to be interesting to see how people react to that. With everybody expecting it to be negative, it'll be really interesting to see how they react if it's positive.
You put another quote in there too that effectively says, go too far. What does that mean?
Well, I think that the quotes from Albert Camus, who's a philosopher or whatever you want to call him. I don't know. I always thought he was kind of dreary myself, but these two quotes I used this week I thought were appropriate. Go too far. Well, go too far. What does that mean? Well, right now, for instance, and I'm not saying this is what's going to happen. People always misinterpret this. I'm just saying that this is an example of what I would say that means when it applies to investing. Go too far. So right now, everyone expects a recession. I mean, I don't think there's any doubt about that. There's very few people out there who say we're not going to have a recession who don't have a political agenda. Okay. I mean, I think that Joe Biden certainly is going to say, we're not looking at recession. And I think that, people with, have public, have an influence over public views of things have to be careful what they say. So Jerome Powell's not going to say we're headed for recession. But that is to go to an extreme would be to say we're not going to have a recession. That's something that is not expected, completely and utterly not expected. I'm not saying it's going to happen. I think we probably will have. Well, actually, we will have a recession at some point. We haven't outlawed them. When it comes, I'm not sure. But we will have one eventually. But to say right now that we're not going to have recession, say in the next 6 to 9 months. I think that's what it means to kind of go to an extreme right now.
You brought up Jerome Powell. The Fed meets later this week.
Yeah.
Initially they leaked information saying they were going to raise a full percentage point. Now then that's back to 3/4 of a point. What's going on there?
Well, it is interesting, again, how people react to the incoming data. That's what I was saying before. It does affect people's view of things because we don't know what the data is until we have it. So look, we did, the last meeting, they ended up going a full 75 basis points after they had told people they were going to go 50. And so I think that was a mistake. I think it was I think it was panic. We talked about that. So now we got some more, kind of rough inflation data a couple of weeks ago, and people started thinking, well, they're going to go a full percent this time. Well, that kind of faded as the economic growth data looked weaker. And so now they scaled it back. Well, they're going to go 75. But I think the data has come out weak enough now where people are even questioning whether they're going to go 75. What if they come out and go 50? And, listen, I think they need to stick to what they say they're going to do. If you're going to use forward guidance and say, we're going to hike 75 basis points at the next meeting, which is essentially what they've said, you need to follow through. I think it goes to the credibility of the Fed. Look, I don't think it really matters in the end. The Fed is a follower, not a leader anyway. Look, when we get close to recession, when we start to see recession coming, you're going to see short-term rates and long-term rates are both going to go down. And it's not going to be because the Fed cut rates. It's going to be because the market sees recession coming and prices it in. The Fed will end up following the market. We're not there yet. So I don't know that it really matters what the Fed does. What does matter probably is what they're going to say. And I think that what really the market was trying to price last week is the idea that maybe this hike is the last big one, that you're going to go, that the pace of the rate hikes is going to fade and be smaller going forward. And I think if Powell says something like that during the press conference or he hints at that, market's going to like that because I think that there's this fear that the Fed's going to hike into recession. Like I said, I don't really worry about that because I think the market really, look, rates are influenced on the short end by the Fed, but if they see recession coming, they're gonna buy the short end, and rates are going to fall. So I don't know that it really matters, but it will be interesting to see how the market reacts to it.
Last thing today, you said in the report there were a couple of reports that came out last week that worried you: the LEI and the S&P PMI.
Yeah, look, those really were reports that really concerned me. The LEI, leading economic indicators from the Conference Board, look, that has a very, very long history. And almost, I think every recession, going back as far as that goes, has been preceded by a negative change year over year in the LEI. And we're not there yet, but we've had 4 consecutive down months now, and we're getting very close. If that turns negative year over year, I think we're probably headed for recession fairly soon. The lead time varies, so I can't tell you exactly when. The same thing, or not the same thing, but similarly, the S&P PMIs came out last week. Now, it was a flash PMI, which is kind of a preliminary reading. So I don't put as much emphasis on that. And I would say, too, that the S&P bought the company called Market. Market used to put these out, MARKIT, by the way. They got bought by S&P, but those were always kind of the secondary reports to me. I never paid a lot of attention to them because I didn't see them as being as reliable as the ISM reports, which come from the old National Association of Purchasing Managers. But the real down piece there was services. Look, kind of the idea, I think, of what my operating kind of view of the economy right now is that we have to have, or we're starting to see a fall off in goods demand because goods demand was elevated during COVID, and we're seeing a return to trend of services. So you've got goods falling and services rising. If goods are falling and services start falling too, that is a very, very bad sign. And I think we would be in recession if that turns out to be true. Now, look, the ISM non-manufacturing survey did not show that when it came out a couple of weeks ago. We'll see where it goes. We'll see where the finals are too. We get the August 1st and 3rd, you get the manufacturing and the services PMIs out of S&P. We'll see what they look like when we get there. But yeah, services turning down would not be a very good sign here. That would be a sign that we probably are headed for recession fairly quickly.